On March 18, 2026, HDFC Bank experienced a sudden 7% drop in its ADR. An ADR, or American Depositary Receipt, is a certificate that allows U.S. investors to easily trade shares of a foreign company. During U.S. trading hours, the price fell from a previous close of $28.71 down to roughly $26.60. You might expect a drop like that to follow a disastrous earnings report or a major internal scandal, but neither happened. HDFC's fundamental operations were intact. The selling pressure actually came from outside the building. Investors were reacting to a spike in global market volatility, brewing geopolitical fears, and regulatory chatter regarding how banks distribute insurance products. Because U.S. markets are highly sensitive to these global macro anxieties, the ADR acts as an emotional amplifier, reacting violently to headlines, while the Indian home market is entirely closed. That leaves a massive question for the opening bell in India. Does an overnight bloodbath in New York guarantee a crash on the NSE, India's primary national stock exchange? Historically, because the two markets operate in different time zones, a sharp 6 to 7% drop in the U.S. serves as a leading indicator, often pulling the domestic Indian shares down by 1 to 3% the following day. This shows why a 7% U.S. drop rarely equals a 7% Indian drop. The U.S. ADR trades at a 168% premium, $26.60, versus the Indian equivalent of $9.92. This creates a hard floor. If NSE shares fall today, arbitrageurs will immediately buy them to capture the gap. The mathematical mechanics of cross-border trading act as a natural shock absorber. They isolate domestic investors from Wall Street's panic, limiting today's expected local downside to a manageable 1 to 2%. If we ignore the flashing red screens of overnight trading and look strictly at the math behind the business, a very different picture emerges. This plots 44 institutional analysts covering HDFC, 39 rated a buy, 2 a hold, and 0 recommend selling. The target projects a 13 to 20% upside, aiming for 2,271 rupees. Furthermore, Jefferies raised their target to 2,400 and Bank of America to 2,250. The professionals evaluating the balance sheet see a 7% drop driven by macro fears as a heavily discounted buying opportunity, driven by market overreaction. This institutional confidence is anchored to HDFC's internal growth blueprint, stretching through financial year 2027. The bank projects a 15 to 18% compound annual growth rate in PAT. PAT stands for profit after tax, the true bottom line cash generation of the business, and growing it at nearly 20% requires highly efficient operations. To fuel that profit, HDFC plans aggressive loan expansion, targeting 12 to 13% growth. They are intentionally structuring their lending to outpace the average growth of the broader banking system. Management expects to hit these targets while stabilizing their NIM at a healthy 3.35%. NIM is net interest margin, which measures the profit difference between the interest a bank earns on loans and the interest it pays out on deposits. HDFC's fundamental trajectory is aggressively pointed upward. The core business is entirely detached from the noise of yesterday's isolated stock sell-off. But that FY27 blueprint is not guaranteed. Wall Street sentiment is a distraction, but there are genuine structural threats inside the Indian banking sector that could derail those numbers. The most critical hurdle facing the entire industry right now is the fierce competition to secure cheap capital. Look at this diagram detailing the credit-deposit ratio. The CD ratio measures how much of the money a bank raises in deposits is being sent back out as loans. Right now, HDFC is running high at 82%, meaning a massive volume of credit is flowing out while the pipe for incoming deposits is highly constrained. If the bank cannot expand that narrow pipe and mobilize more CASA, current account savings account deposits, which are the cheapest funds available, they will be forced to borrow money from the market at significantly higher interest rates. When the cost to acquire deposits rises, but the rates charged on existing loans stay sticky, banks experience margin compression. That healthy 3.35% margin projection shrinks rapidly. Winning the ground war for cheap domestic deposits is the true existential battle for HDFC over the next 3 years. There are secondary economic headwinds. The bank faces a retail slowdown in mortgages and credit cards, alongside strict new regulatory curbs placed on unsecured lending. These credit risks act as a mathematical speed limit. If deposit growth lags and consumer lending tightens, HDFC will be forced to throttle back its aggressive 12 to 13% loan growth targets. A 7% drop in an overseas ADR is a temporary illusion of risk, smoothed out by arbitrage and time zones. The undeniable reality investors must monitor is whether HDFC can balance its domestic deposit ledger. The information provided in this video is for educational and informational purposes only and does not constitute financial advice. Please consult a SEBI-registered investment advisor before making any investment decisions.